All right, happy Monday. We're half an hour away from the opening bell. Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm David Ingles with Yvonne.
Our top stories this morning: investors bracing for this week's big central bank decisions, including a Fed call set to reveal whether policymakers remain on track for 3 rate cuts this year, or could the dock shift higher to 2? We got speculation still building on the BOJ set to end negative rates.
Right. Now, China is expected to report muted economic activity numbers to start the year, raising doubts a bit about its ability to meet its growth target.
Plus, an exclusive interview with ANZ CEO Shayne Elliott on the outlook for business, interest rates, and the global economy. All right, Monday morning, and yes, it is a busy week. Did we talk about this map? It shows it all. I think I counted close to a dozen or so central bank decisions this week alone. I mean, we're talking about nearly half the world is going to be coming up with some sort of policy this week here. I think first and foremost, though, if you have to laser focus into two, I got to choose BOJ and Fed, right? What about you?
Yeah, well, you're forcing me into it now. So it's the BOJ, the Fed, and then it takes us into the RBA. There's pretty much one every week, every day of the week, plus twice on Sunday, as they say. Really what the guidance will be from central banks, and certainly bond markets last week, and certainly when you look at pricing right now, at least on the BOJ, right? So BOJ ends tomorrow, and certainly you're looking at 28 basis points of hikes priced in when you look at swaps, for example. Goldman's coming out with their note. They're actually now expecting the BOJ to raise rates tomorrow. They're also updating some of their calls into future rate hikes as well. So that's just the BOJ. Of course, we got to talk about China as well. Big day today.
Yeah, I mean, we have the data dump that's coming up in the next hour as well. Credit data certainly was still looking weak as well. So this is, keep in mind, the tally of year-to-date numbers, right? So it's still looking like the headline numbers might still show a bit of a slowdown. Bloomberg Economics has a little bit more different take on it under the hood, maybe more signs of stabilization than deterioration. But in terms of what your agenda looks like here today, we talked about the data dump. Hong Kong volumes when it comes to this equity market have been picking up, right? And you certainly have seen what we're seeing in onshore markets as well. The southbound connect flows, I mean, are continuing to be, 22 straight sessions where we've seen net buying. CSI 300 is up 5 straight weeks already. EV stocks in focus, more push, of course, these new productive forces and the like. We have a big EV segment coming up a little later on. Copper, iron ore showing 2 different things, right? Mr. Copper, Mr. Growth continues to edge higher here today. Iron ore continues to be a down arrow story, and we got some jobless rate numbers coming out of Hong Kong a little bit later on.
Yep, there we go. Lots of stuff to sink your teeth into. As you can see, copper and iron ore coming online. Italian 1.7% to the downside in the opening minutes. A glance at market action as we approach the opening, about 26 minutes away. So every single day last week, pressuring iron ore prices. Equity markets, the story is 0.5% to the upside, although that being said, we're still fairly muted as far as the market breadth is concerned. A50 futures coming online in Singapore, flat open there, as Yvonne is pointing out. 5 straight weeks of gains on the CSI 300 nearly every single day going back to the start of Feb in terms of net buying across the stock connect coming into Hong Kong and the dollar China, of course. That exchange rate has practically been frozen at about these levels for the better part of the last few weeks or so. Yeah, so it's busy. I haven't even mentioned earnings, by the way. It's a big week as well. China earnings. You have Tencent coming out. Xiaomi, I think, gets tomorrow as well. So keep your eye on that. But there's a lot to talk about ahead of that, of course.
There's a big NVIDIA event, too. I think we're taking a look at a little bit later on this week as well. So it's busy. Yeah. Everywhere you look at. All right, let's talk a little more about what's on tap here, which is the eco data, and that data dump set to come through at the top of the hour. Likely mix at the start of the year, with property still a major drag, and data due later on is expected to show retail sales rising, but growth in industrial output slowing as well. Let's get to Jill Desis, our China economy editor, joining us with a preview. What are you watching out for the most, Jill?
Yeah, well, I think ultimately, Yvonne, you really want to look at any of those retail sales figures, right? Those consumption numbers. Remember, we did see CPI tick back toward positive in February. A lot of economists thinking maybe that's going to be a short-lived uptick before we're back in deflationary territory this month. But I really would like to see what those holistic January, Feb retail sales figures look like. Obviously, you have to account for the Lunar New Year holiday. That did boost spending quite a bit, as well as travel. But if you recall from just a couple of weeks ago, ago, we talked about how per capita spending was still fairly weak. So I do want to see whether there's help there. I think, the fixed asset investment figures, probably you're going to see an uptick for January, February, but that might be just some front-loaded, government-backed state spending on infrastructure projects, some of that economic stimulus kind of trickling through. And then I think the industrial output numbers might actually be fairly interesting because if you remember, the export data for January, February was a lot better than expected. Now, obviously, Chinese officials still saying there's a lot of difficulty on the horizon. We, have talked a lot about U.S. sanctions on Chinese goods and such. But yes, so lots to look out for here. Although, again, because you're combining 2 different months, it might be a bit noisy.
Well, combined aggregate financing, Jan and Feb was $8 trillion. That sounds like a big number as well. That was out late on Friday. Just what's the nuance here?
Yeah, I think that the issue that we're seeing with some of that recent credit data is that loan growth was still quite weak. And so I think you're still seeing some of that implication of, there's a lack of borrowing demand within the Chinese economy right now. And it doesn't really seem like the government has been able to do a ton to actually get those numbers going again. We saw a similar pattern in January as well. Again, that weak loan growth, those weak loan growth figures. And so I think what all of this is pointing to is that continued issues with confidence in the Chinese economy that we're not really seeing, any kind of like a major turnaround there. So ultimately, I think, we'll see what these numbers tell us today, but we've had sort of a mixed bag just already within the first couple of months of the year.
You guys have an interesting piece out talking a bit more about this new buzzword, new productive forces. How should we interpret what this all means? I mean, certainly it's turned the market a little bit last week in terms of a little bit more towards the growth sector in China.
Yes. So ultimately, new productive forces, a phrase that Xi Jinping started trotting out, I think, last September. Now we've seen it play up front and center at the National People's Congress recently. Ultimately, what it seems to be is this idea of funneling investment into new growth drivers for the economy. So the markets are interpreting that as saying, is there going to be more into, EVs? Is it going to be, some of these new technologies? Sectors, advanced manufacturing. Obviously, this isn't a completely new concept in the world of China. We know for quite a while now we've seen a lot of 5-year plans and such really devoted to this idea of building up alternative types of growth drivers, especially as the property sector has struggled. I think the difference here is that this is actually only the second time in the last decade or so that we've seen an industrial policy type of slogan really kind of take this level of prominence. Usually those slogans are much more macroeconomic in nature. But as with a lot of things in China, it's all about sort of decoding the clues. Is this just really vague? Could things change? As you might recall, just from a couple of years ago, we saw a lot of emphasis on technology-led investment, and then suddenly the common prosperity comes out as this major slogan, and things kind of turn around. So we'll have to see how that develops.
Jill, great stuff. Jill Deese is there, our China economy editor. Now, more to... on our top story, of course, other top story, which is in Japan, of course, Bank of Japan meeting starts today, wraps up tomorrow. Media reports saying policymakers will end negative interest rate policy on Tuesday. Nikkei's up 2%, session highs. Yen is weaker for a 6th straight day. Stephen Engel is with us out of Tokyo, Chief North Asia correspondent. Steve, will they or won't they?
Yeah, it's not much of a secret anymore. Essentially, over the weekend, all the major news organizations, including kind of the gold standard for financial reporting domestically, and that's, of course, the Nihon Keizai Shimbun, the Nikkei, reporting that it's pretty much a done deal. And you know how this works, David. Essentially, the BOJ, ahead of its decision, which is coming out tomorrow, will have to inform the government. But then there might be elements within the government that, for political expediency or political reasons, might leak it. So it's essentially been leaked. So I think if you're a betting man, you would say tomorrow it's going to happen. They're going to exit the 17-year-old negative interest rate policy. You saw the numbers there, probably by more than 0.1% hike to a range of 0 to 0.1%. And, it's not a big bang hike, obviously. And we're very unlikely tomorrow at the press conference that starts at 3:30 local time with Governor Ueda. He will probably take a fairly dovish tone and also essentially indicate that he's going to have a more accommodative stance, and very unlikely, of course, to basically telegraph any future hikes. I don't want to necessarily put a whole, slam on the brakes to what they've seen already with this, I would suppose, a more virtuous cycle of inflation above already the 2% government target, but it has been in disinflation. It's starting to slow. It's at 2.2%, and that's the big concern, is that perhaps without these wage concessions and wage numbers that we got, which blew, way past expectations, inflation is starting to come off the boil a little bit, and that would be the concern. I've been up to Niseko a couple of times this year, and they have a lot of pricing power. Prices are going way up in the ski resort because the foreigners are coming in, and they say, wow, the yen at 149 to the dollar, everything is cheap. But to the average household, it's a lot more of a burden. So again, that's the big concern is, you don't want to tighten too fast.
And Steve, I'm looking at the market. I mean, the yen's weakening again. We're at 149 levels. You talk about some dip buying, I guess, on Japanese stocks post what we saw last week. Is there a sense that the BOJ has been successful already in relaying that message that maybe not aggressive tightening, but tightening is coming soon?
Yeah, I mean, again, the yen, no one is expecting a big, sharp increase because, again, it's a king dollar story still, and the Fed has a lot to do with that. So, it's been trading right around 148 to 150 over the last couple of weeks as we got a better indication that the BOJ will exit negative interest rates. And it might start slowly creeping higher, but again, no one is really expecting a sharp appreciation in the yen. Again, it's really helped the profitability of corporate Japan. What was it? Toyota last week essentially saying that for every 1 yen increase by the dollar, it's about 45 billion yen increase in operating profit. So they've definitely benefited. But going forward, you're absolutely right, Yvonne. Governor Ueda is going to maintain his accommodative stance, and that's probably why. And again, David, earlier you alluded to that Goldman Sachs report that came out early this morning. They've changed their call, essentially say that they will hike tomorrow and also, of course, keep a steady purchase of the JGBs and the bond purchases, because, again, that any cutback on bond purchases would perhaps indicate to the market a less accommodative policy, and Governor Ueda is still going to be cautious.
Steve, it's been a busy 72 hours. I think it's going to be another busy 48 or 72 as well. Yep. Stephen Ingles there, Chief Asia correspondent in Tokyo. He's at the right place at the right time. Still ahead, Dubai's ruling family is opening a branch of its family office here in Hong Kong. We're speaking to the chairman, Sheikh Ali Rashid Al Maktoum, about why they chose the city for their first office outside the UAE.
But ahead of that conversation, we're talking with SocGen. Frank Benzimra joins us in a couple of minutes here. We're talking all things Fed, Bank of Japan, and what do you do with all that information coming this week? Counting down to the open of trade, 17 minutes away, Shanghai, Shenzhen, and as you can see, a foggy Hong Kong this Monday morning. This is the China Show. Good morning. Right, 720.65 right now in dollar offshore. Your reference rate is just out of the PBOC right now. Your midpoint is at 709.43 against the U.S. dollar. Bit of backdrop here. We are weaker for a fifth day on dollar China ahead of the open today. All
right, let's bring in Frank Benzimra, head of Asia Equity Strategy at Societe Generale. He joins us now. I mean, Frank, how should we wrap our head around all the event risks this week? What's going to be most important to you?
Well, most important are the central banks. And well, what has been interesting is on the Fed, there has been this, the equity market is not too much concerned now on what the Fed is going to do, and we see this decreasing correlation between bond and equity. So I think that's one of the interesting things, but not much to expect in terms of a rate change. We think it's going to be unchanged. And then the Bank of Japan, and well, again, not much surprise to expect. So we think that the negative interest rates are going to end, but that's not going to end the bull market on the Japanese equity in our view.
Yeah, I think one of your key calls is keep your exposure to East Asia, markets like Japan, for example? Just underscore that view for us.
Yes, so both within emerging Korea, Taiwan, and ex-emerging Japan, while the export is going to be one of the key sector. And that's interesting to see this divergence between the economy, which is not in such great shape, and the equity market. And this has all to do with the exporter, which are going to make still better profit with this level of yen and with the economic outlook in the US, which remains good. So I think that this divergence could continue in the case of Japan.
There seems to be more interest in China now. A bit of a rotation, maybe out of the Indias, a little bit out of the Japan. Are you seeing that rotation in a meaningful way now?
Yeah, well, we've seen a little bit of rotation, but I don't think it's going to be meaningful enough, because what is really missing in the case of China is earnings. They are not recovering. And we have this downward revision, which has been there since 2021. And there is no sign, actually, when you look either at the micro level, on the earnings level, or at the more macro level in terms of policy easing, that it's going to change in the short term. So probably there is a lower downside, but to get this big upside, which would be the reason to go back on the Chinese equity market, we need to be a little bit more patient in our view.
So you mentioned earnings. What do valuations tell you right now? And I'm just going to paraphrase something from your notes here. My valuation model shows some convexity. What does that mean in simple English?
Well, it means that you have the downside, in our view, is around 15-20%, and then you could get some upside of 50-60%. So this is what we mean by convexity when we are using our valuation model. And what we use is actually a kind of a long-term model. So we look at the long-term growth of 5.5%. So if we go from 5.5 to 6.5 in nominal, so that means that to end the deflation, then you have this big potential. But the question mark is when and how the deflation is going to end. And this is really where we are not ready yet to pull the trigger and to take a big overweight position on
We've
this
seen
market.
a bit of a shift towards maybe post-MPC growth sectors, right? Or,
Yes.
this whole new productive forces is letting, a lot of these sort of names to kind of gain a bit more traction. Is that something that you're looking at now?
Yes,
More so?
but now if I translate this into the equity market, these are some sectors which are doing well. They have leading market share in the world, but you also have some overcapacity.
Yeah.
And this is something which is creating some stress on the earnings. So from a macroeconomic point of view, yeah, it's good, it's making sense, although we would have like more on the consumption, but we have to be more patient on that. But from the equity point of view, the risk is to add some overcapacity, and this is where we are a little bit concerned.
One last question on China. Where do I maintain exposure, given that you're not ready to pull the trigger on an overweight, though?
We are maintaining the exposure because, as I said, the valuation is not very high. We have this convexity in terms of what our model are saying. And then we need to get some diversification in a global portfolio. Because what we have, even if I stay on Asia, Korea, Taiwan, it's very much about the US, about the S&P, about the financial condition in what we see in the US. So if we see some reversal, then you need to get the diversification, and this is still one of the places where you can get it. So you have the valuation and the diversification element, which let's keep some exposure, although we don't want to be very brave on this.
You're being a bit more brave when it comes to Korea, though. You have a bit of a view out of consensus that this is going to be the start of a bull market. Is it beyond just the tech plays and the AI plays? The whole value up corporate governance side, is that something that you're factoring into too?
The first thing that we're having in Korea is it's been through 2 years of outright contraction in the profit, and this is the year where we see this recovering. And on top of that, you have some announcement on the value up program with all the political pushbacks that we can see around it, but there is an intention, and given, and it's not that many markets in the world where you have some level of valuation which are not very elevated. So I might be a little bit biased with Japan, which is really the market that I spend a lot of time to look over time. But I really see where Japan was in 2013, 2014, where is now Korea when it comes to the discussion about governance. Also, there are two very different market structure, and the corporate structure is very different. But in terms of the intention, we are maybe at a similar place.
And what criteria are you using to pick your sectors in Korea? Would it be the same sort of model you used for Japan in 2013, 2014, since you mentioned that?
We look at the company with a low payout ratio, and the company with a lot of cash, and with the ability to increase the return on equity. And then you need also to see the split between some part of the market which are part of the Shebol and the one which are not part. So, for instance, the banking sector in Korea is one of the very interesting one on that matter.
Frank, hi to your team for us. Have a great week ahead. Yeah. Frank Benzimra there, Head of Asia Equity Strategy at SocGen. Just going into the opening bell, 7 minutes away. We're looking like this. Hang Seng is down about 51%. Steady on dollar China. Your 10-year yield, 234 as we speak. 6 minutes away, well, 7 minutes away, the opening bell. You're watching the China Show. Happy Monday morning and welcome back to the show. Hope you're all well and a restful weekend. Are you ready for the week? We're not. There we go. We're in offer right now, equity markets. All that being said, though, I mean, there's a lot of event risk. We've talked about central banks at length and really how extremely packed this week looks to be. Apart from that, though, in the next, 35 minutes or so, China releases, of course, activity numbers coming through. Ahead of that, just keep in mind, we have been looking at a lot of flows. Do we get day 23 today as far as net buying for mail-in investors? Certainly want to watch, and perhaps also goes into why, and a function of why volumes and turnover here in Hong Kong have been both picking up of late too.
Yeah, in terms of analyst actions, we talk about the earnings story in China, and CATL certainly is one that has benefited from it. We're getting an upgrade from JP Morgan on that stock here in particular, raising that price target among some of their peers too. 220 renminbi for CATL. It says upside to earnings, re-rating to the stock thanks to the beat in dividend payout and strong cash flow. AIA Group also rated a new buy at Northeast Securities. Beijing Kingsoft also rated a new accumulate at CLSA. Stocks to watch here today. CATL will watch very closely later on here, but certainly that's one to watch at the open. EV stocks, we've been talking about XPeng playing cheaper EV brands according to Reuters as well. And we're watching some of these miners, given copper is going one way, continue to surge higher. Iron ore is heading south. The open is next. This is Bloomberg.
Welcome back. Happy Monday morning. 40 seconds to the opening bell. If you're just coming to the office here in Hong Kong, it's probably like a scene out of the opening minutes of Lord of the Rings. Twin Towers, clouds of mortar over the city. That being said, looks like it's fog anyway, not smog.
I'm sure it was more beautiful in Paris last week.
It really was, except it was raining cats and dogs. So.
Oh, yeah. Okay.
All that being said,
you're
going to help me through this.
We had sunny skies all weekend here. Yeah. I'm not jealous at all about your Paris trip at all, Dave. But yes, we're taking a look at when it comes to this open. Yeah, there seems to be more momentum when it comes to some of these Chinese equities. We talked about that fifth week of gains when it comes to onshore. We're certainly watching that data dump very closely for any signs of clues, whether there is maybe some recovery, at least stabilization in the data as well. But here's what your Monday morning is shaping up to be here. Hang Seng is a little bit on the back foot here. We're flat when it comes to that index here. And CSI 300, there you go. We're pushing forward here, extending those gains up about 1/5 of 1%. Slow going, of course, just given the data dump and what's ensued here this week. Asia's Tech, though, on offer. We're watching 8 shares as well, just slightly to the downside. We're still waiting to see if we get to the bull market territory for that one. Didn't quite make it last week. And you continue to see more of this roiling when it comes to commodity markets, right? So iron ore is doing a little bit better in China, but Shanghai crude is down some 2%. We're watching copper futures very closely here, just given some of the shortages around that, the continued spikes that we're seeing when it comes to that metal. And there you go, sector by sector, it's a mix. bag here overall. Developers are catching a slight bid. And we're taking a look at when it comes to financials, industrials. Industrials seem to be still continuing to do well here this morning. That was one of the key sort of sectors that Frank Benzimra mentioned about from SocGen and where you can still gain exposure in the mainland. And we're watching when it comes to movers here today. So CATL, that one's catching a bid, massive bid here this morning. We're up some 5% for the stock post earnings. So full year net income beat estimates. You're hearing more analysts raising their price targets given just the strong beat, strong cash flow according to JP Morgan. They have an overweight on that stock here right now. XPeng as well. We're watching earnings this week. 3% pop there. There was talk about possible cheaper EV brands coming through from XPeng. That's according to Reuters as well. And we're watching BYD, that stock close to 2% gains right now, Dave.
Well, that's a perfect segue to get us into an earnings preview of the week. You have the tech giants also coming out with their financial results here. Let's bring in Rachel Yeo, our breaking news earnings specialist, to really talk us through all the big names. Why don't we start with which company you want us to start with?
Yes, sure. We can start off with Xiaomi first.
Okay, why not?
So
okay.
Well, it is an EV company now, sort of, right?
So their expansion into EVs will actually be, scrutinized, when they report earnings later this week. So alongside, we've also established competitors, XPeng, which is also reporting this week as well. So for Xiaomi, they will launch their very long-awaited SU7 series later this month. Okay. So this will be quite well. This was well received by the market when they made the announcement earlier as well. So their annual adjusted profit is set to double this time, and also their foray into EV vehicles could also bring long-term growth to the company and also to boost sales as well. But on the other hand, for XPeng, we might see deeper losses for this time because of the as they try to keep up with intensifying competition in the EV sector, and they've also been slashing prices for their vehicles to catch up as well.
Yeah. What about when it comes to the China tech space? I mean, the big ones like Tencent, Meituan are also earning results coming out too.
Yes. So for Tencent, we're expecting to see strong growth this quarter as well, thanks to the sales rebound in advertising, international games, and fintech for this time. And also, Tencent's profit will also be driven up further as with more AI-enhanced ads and also stronger demand for short videos as well. So we will see how that would play out in the upcoming earnings. And for Meituan, we are also expecting Meituan to perform better also because they have seen success in expanding beyond mainland China for their meal delivery services, such as in Hong Kong as well. And the company has also invested in newer businesses such as grocery retail and also live streaming to keep up with competition as well. But in terms, shareholders may also expect more cash return this year as well because Meituan now has surplus cash and they do not see much M&A opportunities coming up, so that money will likely return to shareholders.
All right. We'll see if we get any news of that. Rachel Yeo there, thank you, our breaking news earnings specialist joining us here in Hong Kong. There is more going to be on China's booming EV market in the next hour where we're joined by HSBC's Shanghai Securities Head of Autos Research to talk a bit more about that sector. Yu Chen Ding joining us. Sue.
Yep, there we go. In the next hour of the show. Before that, though, stay tuned for a great conversation coming up. Dubai's royal ruling family is opening a branch of the family office here in Hong Kong. We'll speak to the chairman about why they chose the city and what their plans are here as they open up in the city, cutting down, of course, to the release of the data activity numbers coming out of China, what 25 minutes away. A glance at benchmarks as we kick off a fresh trading week. You're watching The China Show. Good morning.
Well, Hong Kong has been looking to promote the growth of family offices here in the city and really trying to catch up or at least battle against Singapore in a bid to attract the super rich. The city has introduced a new capital investment entrance scheme for foreigners just a few years ago, including the mainland Chinese over the age of 18, right? This is what was laid out. Applicants must make a minimum investment of 30 million Hong Kong dollars, with the vast majority of it in financial assets. We did hear, of course, back then from John Lee, the chief executive of Hong Kong, saying that target, right? 200 or more family offices to establish or expand their operations in the city by the end of 2025. Dave.
Yeah, well, on that very note, certainly quite a timely conversation coming up here. Joining us here on our Hong Kong sets is His Highness, Sheikh Ali Rashid Ali Saeed Al Maktoum, a member of the ruling family in Dubai. He's also the chairman of the family office of Sheikh Ali bin Rashid Al Maktoum. And also joining us here on set is Eleanor Mack, vice chairman and CEO of the family office. Welcome to Hong Kong, first and foremost. Thank you for making the time. Nice to see you as well. Why Hong Kong?
Why not Hong Kong? I mean, you know, for me, I would say that during my first visit, which was early, actually December last year,
okay,
I got to see a lot of similarities with Dubai. I think Hong Kong is very advanced in so many aspects. It has so much to offer in terms of investments, opportunities, and business expansion. And I can see like there's a potential for long-term growth that can happen. And so we kind of went on with the idea, and through a few friends, through talks, and now we're in the process of establishing that family office here in Hong Kong.
And you mentioned talks. How, if I could ask, how long was the prior engagement with the Hong Kong government leading up to this decision that we're in right now?
Well, I think it took around one or two months. Just
pretty quick?
Yes, it's pretty quick because, you know, I feel like, you know, once you find the right people to help guide you and establish things, you have the right connections also, things can move fast.
Right.
And I feel like, you know, time is of the essence, so might as well actually do the best and cater to making a positive change around the world. And that's what my family office wants to be all about.
Okay, Eleanor, let me bring you in. What are your initial plans? What's the initial priorities here?
Yes, in Hong Kong, because we are looking for the projects that interest in our sectors like AI, construction, EV, and also tourism and fintech. Yes, that we can interest and invest in, and then also we help them to scale up in Dubai and UAE.
Okay,
yeah.
And how big's the fund?
It's up to $500 million.
Okay. And ticket sizes of the investments, how much are you looking to do per transaction? I know that's a moving target, but is there a range that we can
We
talk
are
about?
open to them. Yes, it depends on the scale. Is it startups or the projects or construction? Yeah.
Do you guys have any targets in mind in terms of specific investment targets at the moment yet?
I think nothing at the moment, but I think it's in the work, in the process. We're open to exploring so many options, and you know, so I think there's you know, through collaboration stuff, I think things will start shaping up and be more clear in time.
Right. When are you looking to make your first investment, if not already?
The first investment would be the construction one, because it's got a very good policy in UAE. Yes. Yeah.
Do you have a timeline for that? When the first?
It would be within this year.
Yeah. Maybe next quarter.
Yes,
or
maybe
towards the end of the
quarter,
year. Yeah.
Okay, and you guys are in talks already with potential target companies,
yes.
I would imagine?
Yes, we are. Yes, we are.
Okay,
Yeah.
Talk to us about parallels between, you know, Hong Kong is the first family office outside of Dubai, of course. Yeah, what are the parallels that you're looking to take advantage of, Hong Kong and Dubai, for example?
I think, first of all, Hong Kong, you know, it has the services in terms of, you know, the legal and investment management. I think which is very appealing actually, and also the connection to the Greater Bay Area in the mainland China, which is what we, even back in Dubai, we hugely look up to, and we were very much aspire also by the technologies and also the investment movement that has been shaped over the past maybe 50 or even 100 years. And it's known that China and Hong Kong are one of the leading players in terms of investments and opportunities. So I want to take advantage of that, and that's why, you know, I thought this would be a good step for me to also to bridge and to strengthening the bond, you know, through the family office. And also, me, first and foremost, I think my initiative through creating this family office is to be able to have a positive impact. You know, through each and every project, I want it to be a meaningful approach towards creating a better tomorrow. And that's what my family office will be all about. Yes.
I should have asked you this at the start. Why initially the thought of branching out of Dubai in the first place?
Well, for me, I've always been surrounded with people from all around the world, and I think for me, I always wanted to make an impact in people's lives, and so I think through maybe businesses or, you know, charity work, which is also something that I really stand strong for. I want to be able to like have maybe foundation in every country, just so that I can give back. It's a way for me to like, you know, see people also succeed, because that's also one of my visions is to be able to uplift people in every sense of the way, whether it's my team or whether it's with people that I meet. So I think we want to put projects together that help to shape up the next generation and the future also.
And how do we take this philosophy into sort of tangible investment strategies, for example, in terms of the sectors you're looking at or the targets you're looking at?
We are looking at we are also aligned with the Hisayuki's vision and mission.
Yeah.
Yes, that we will target on the real estate market right now. It's because we would like to start with more conservative ways.
Okay.
Yes,
Okay.
and also other than the startup, yes, and the projects, yes.
Right. So when you mentioned startups to maybe companies that are further down or further developed, for example, are we talking everything from VC to private equity, for example?
Yes, something like that, yes.
Okay.
Yeah.
And in terms of, how much are you looking to deploy in mainland China? Specifically, you mentioned GBA, for example. So I'm wondering whether you distinguish between Hong Kong startups, mainland startups.
The startups, we are looking for the technologies. We are open to all. And actually, no matter which region, which countries, that as long as it's a good technology, that we can have to scale up in UAE, and then we will bring it back, yes.
Okay. Plans outside of China, for example, are you looking at elsewhere in the Asia Pacific to deploy capital?
I mean, I don't want to limit myself to or be put inside a box. Yeah. I think the world has so much to offer. So we'll definitely, take the step also to learn, as that we can cater and adapt to different parts of the world. So definitely, there's a long way to go. But I think Hong Kong being the first also family office outside the UAE is something that I'm very much excited and very proud of. And I'm sure, with everybody's guidance and help, we all can make it happen and do great things together.
Yeah, and just for reference, of course, we just glanced at the team, which is right behind the cameras here. Of course, there's a whole contingent as well. Final question: what are the risks that you're looking to manage, generally speaking, as you embark on this new journey, Eleanor?
Pardon me. What kind of?
What are the key risks that you're looking to manage?
The key risk.
There could be something.
Yes, this could be. We are looking for the risk as. What we are about to be concerned?
Does a slowdown in the economy concern you, for
I think
example?
something that might affect the world wide. If there's we hope we don't run into an economic crisis again.
Hopefully not.
No, but I think there's so much more happening, things that are happening in the world. But hopefully we'll be able to cater or understand how the market works, so that we don't end up investing too much at a period where things might be slow, and the vice versa. So I think that would be one of the main challenges. But hopefully, through the dedicated team that we have, we're able to anticipate such movement in the markets and cater to things.
Okay. Look, final question: are you hiring? What are the plans around building your team here, for example?
Yes. We at the moment we are actually growing.
Okay.
We're finding the right key members that can help to add value, not just to us but also to themselves. Because I also want to see people grow. It's a vision of mine to see people have a steady growth, because for me it's been a movement of togetherness, rather than say it's all about me. It's not about people working for me, it's about working together for a better tomorrow. Yeah.
Thank you for making the time to come in. Have a great rest of your trip. It's great to see you, of course, here in Hong Kong. And let's chat again next time. There we go. That was Sheikh Ali Rashid Ali Said Al Maktoum, chairman at the family office of Sheikh Ali bin Rashid Al Maktoum, and of course Eleanor Mak also joining us here, vice chair and CEO of the family office. And by the way, you can get an insider's guide, since we talked about Hong Kong there, to the money and people shaking up the financial hub here. It's our new Hong Kong edition newsletter that's out every Thursday, so do sign up on the link on your screens. Check that out. More ahead. You're watching The China Show. This is Bloomberg.
We've been saying that the Bank of Japan is very likely to be tightening policies.
My view is that it will be a very dovish exit.
Market split between a March and April exit from negative rates.
Japan raises interest rate, the US goes lower, the yen strengthens a little bit.
I don't think that they want to risk any financial instability.
The stock market has performed very well on the weaker yen, amongst others. So that could take a bit of the zest out of that.
Yes, there will be hiccups, and it seems that these couple of months would be a little bit rough for Japanese equities, but at the same time, they can give you opportunities.
The money then leaves Japan. Where does it go? That's the interesting one. And that could bring us back maybe to China.
All right, some of our Bloomberg TV guests on our latest MLive Pulse survey about what is the BOJ going to do, what does this mean for the equity market and the like here. And some more of the results that came out was quite interesting, right? You know, what is going to perform best this year? They choose between the Nikkei, the S&P, or the CSI 300. And this is what we're seeing in terms of some of the responses here so far. I mean, still, the U.S. remains the best play in town.
If you're an Asia bull, you're not going to like this.
Yeah, and even with Japan is 28%, I mean, 23% goes to China, so it's pretty split in some ways. In terms of where dollar yen's going to end up as well, I mean, what are people saying, Dave?
Yeah, so dollar yen, well, I think keep in mind first we're weaker for 6 days, now, right? And, you know, arguably this has been well priced into markets right now. You look at swaps, for example, and where will the U.S. dollar end this year? As you can see, 70% basically see a stronger yen, and not just a slightly stronger yen, right?
Wow.
And 120 to 140 is quite a big step from current levels. Let's call it 150. As we speak. Now, is that deflationary in some ways? We'll see. In terms of price hikes, getting price into this market, you look at swaps currently, and this is a moving target, we're looking at about 28 to 30 basis points of rate hikes priced for the rest of this year.
Yeah, you asked the CEOs out there in Japan what they feel about all this, right? How are they preparing their businesses for potentially the first rate hike since 2007, with the BOJ widely expected to end its negative rate cycle as soon as tomorrow. Bloomberg's Haslina Ahmed spoke with Recruit CEO Hisayuki Idekoba to find out what a BOJ normalization could mean for business.
I think, you know, the one big risk factor Japanese economy has is the really weak Japanese yen. So I think same as other central banks, it's just a matter of time how Japanese central bank is coming back to the normal situation.
Has business sentiment improved, do you think? Is finally seeing the kind of growth as we wanted to see?
Yeah, I think, you know, what I'm hearing is finally Japanese companies can increase the prices of items, and that's the first step to increase the compensation and hourly wage. And that cycle, we have to definitely make it better. And so to do that, you know, first of all, we need to increase the price of the items, especially importing goods, items, because of the weaker yen. Everything is becoming more expensive. But I think that's probably the first step to normalize Japanese inflation and economy.
There you go. That was, of course, Haslina and Recruit Holding CEO Hisayuki Idekoba. You can watch, by the way, the full interview coming up. As you can see, that premieres March 28th. That's the next episode of Latitude with Haslina. There we go.
Yeah, and it's interesting. We keep asking that question about, you know, now that we see these Rengo talks come out strong and much stronger than last year, what does this mean in terms of raising your prices of your products, for example? And we did speak with Suntory CEO Takeshi Ninami last week. He said, look, that's a tough one. I mean, they were able to raise their prices of whiskey, I think, early last year. But, you know, you need consumers willing to spend first and foremost. And I think that still takes a bit of time, according to Takeshi there. So certainly consumers, he says, not confident yet. But it is a matter of time, as the Recruit CEO says.
Yeah, I mean, you get into and arguably we're having this conversation because they are entering at the onset of this virtuous cycle of being able to increase prices, needing to account for price pressures, of course, coming up as well, and needing to protect their margins, right? So the next step is really, is this a consumer base that's actually ready to start spending on higher prices? We'll see. Okay, anyway, markets 23 minutes into the session here, we're about a fourth 1% higher on the CSI 300, which, by the way, is on a 5-week run up. Slight weakness coming through in Hong Kong, 0.3 at 1%. If you missed our earlier conversation with Frank Benzimra of SocGen, they're not convinced yet to change to a massive overweight in China, still have exposure, but they're not really seeing this play out as far as earnings go.
Yeah, you need that last hurdle, which is earnings growth, to really maybe see more momentum in this rally. Certainly is what he's been saying in terms of the last piece of the puzzle, really. And that rotation out of India, out of Japan maybe a little bit, is not meaningful enough right now. So focus on the industrials, they say right now, over consumer cyclicals, the like. But yeah, U.S. futures are still punching a little slightly higher. Asia's doing quite well. The dollar is also pretty flat here, but most sectors are in the green. If you take a look at how the region is playing out here today. One stock we're watching very closely, CATL. There you go, the battery maker. The earnings were a beat. Massive upgrades when it comes to raising up the price targets from some of these analysts out there as well. Basically talking about strong cash flow, re-rating even JP Morgan when it comes to the stock overall.
Yep, which reminds us it is earnings season to get us into this week here. So coming up here on the show, we're not done. There we go, our exclusive conversation with the ANZ boss Shayne Elliott. He joins us in a few minutes, and also we're talking all things EVs with HSBC. This is Bloomberg. Welcome back to the China Show, and there we go. So you have a live shot of the, National Bureau of Statistics. It should be coming out with a press briefing shortly after the release of the key economic numbers coming out as well. Retail sales, industrial production, fixed asset investment, property investment year to date, the jobless rate, maybe even, separately, FDI today. So the stage is set.
Yeah.
What do we get?
And the data that we've got recently of late, right? If you take a look at CPI prices, you look at export data, there's signs that point you to some, at least, hope. Right? I mean, how long-lasting is one key thing, but certainly you are seeing in the data less bearish, I guess, or more positive numbers coming through here. So likely we'll see whether this is some sort of stabilization or what. Here you go. So we take a look at when it comes to industrial production. That certainly is a sizable beat of 7% growth for, of course, year to date and really compared to a beat from what the economists were expecting, a 5.2% print. Fixed asset investment, also quite a beat of 4.2%, Dave. Retail sales, that's where we're seeing a little bit of disappointment there.
Relative to the median estimate, so 5.5%. Also getting some numbers coming through on property investment year to date. And arguably, this perhaps is the most important thing, and you're getting some strength coming through in the Chinese currency on the back of largely stronger than expected data, not across the board. Property investment, though, is down -9%. We were looking for a number of -8%. The jobless rate actually ticking up. 5.3%. The estimate was for 5.1%. That's against the backdrop of this NPC target, of course, of creating 11 or 12 million.
12
million jobs. There we go. So I think Yvonne put it perfectly earlier on. Our guys at Bloomberg Economics now think this is really the period of stabilization. Maybe a sharp recovery, perhaps not yet in the offing, but things are at least we pulled back from the cliff.
They've looked at the month-on-month numbers and really what you're seeing in terms of momentum there, and they're saying, look, headline may still look weak, even though today is looking a pretty sizable beat on multiple fronts here. But we're seeing stabilization. We're not quite to pre-pandemic levels, but not deterioration. No. That's sort of the headline that they're looking at here right now. And hopefully that continues. Yep. Of course, you can turn more to your Bloomberg for more on this. Of course, we'll get a little bit more from Bloomberg Economics a little bit later on in the show. So T-Live Go, that's getting fired up here right now. You can get commentary analysis from some of our expert editors. You got to wonder what that means for policy, Dave, moving forward here, if the data is looking slightly less bad. Yeah, well, we have the loan prime rates coming out this week as well. I think no change expected there. And that really leads us into, and by the way, since I'm talking, I'm looking for my list here because it's an extremely busy week for central banks. Half the world will report or will update us on monetary policies. Okay, I'm giving up. Oh, here we go. Okay, so you have the Fed, you have the Bank of Japan, you have the RBA coming out, you have Mexico, plus a few other key countries there as well. And that doesn't even get us started as far as economic data is concerned. As far as bond market pricing goes, it looks like bond markets have, well, to a large extent. Oh, by the way, the dots are also out this week, right? Yeah. So that's really more important. And whether or not it's 3-3, or does 3 become 2, or 2 become 1? Looks like maybe 3 to 2 is what people are leaning toward. And the
cuts, by the way, cuts.
The margin to switch from 3 to 2, they're saying, is pretty thin, right? You only need 2 Fed officials to indicate that for those dots to shift higher. So it could happen. Right? Bond markets certainly have surrendered to this whole higher for longer scenario. Equity market, not so much. But you have seen, I think we're back to those close to 2024 highs for yields now when it comes to Treasury.
Yeah, I mean, yields are there, right?
Yeah.
Yields want yield. Look at your bond. WB, by the way, on your Bloomberg terminals in case you're wondering where you look at that. Okay, let's talk about all things monetary policy, all things banking. Let's talk about the business. Joining us exclusively today, Shayne Elliott, CEO, Executive Director at ANZ. It's nice to see you. Good morning.
Good morning.
How's business?
Actually, business is pretty good. You know, we've spent a lot of time at ANZ getting ready, getting ourselves into shape for tougher times, and I have to say things look pretty good from where we sit. That's not to say there isn't stress out there and people are doing it tough in various parts of the economy, and remembering we operate around the region in 29 different markets, but overall, actually, we think things are going pretty well.
Obviously, with the higher rates environment, people have been worried about mortgages over where you are in Australia. And even the Reserve Bank, Sarah Hunter, is saying households are clearly struggling with rate rises. They're still not quite seeing that change between, that rollover from fixed to floating rates as well. How are you seeing this? Is this sort of just a red herring, or is it, just around the corner?
So I think things have changed a lot in my time, and really, we sort of flip between homeowners or households and people with home loans, and they're not necessarily the same people all the time. So only about a third of Australians have a home loan. And in fact, over time, the people who have a home loan are increasingly quite wealthy. In order to get a home loan, it's never been harder to get a home loan in Australia than in the last 30 years. So the people who have home loans are generally well off. And so that part of the economy in general is actually doing quite well. They're very well employed. Their incomes are rising faster than they have for a long time. They're sitting on quite significant high savings balances, a lot of that to do with COVID. So that part of the market in general pretty good. All of the banks have sort of reported there's emerging stress in our home loan books, but it's still much, much lower than it was pre-COVID. So things are getting worse, but from an almost zero base. Where the households are doing it tough isn't actually the home borrower market, it's the renter. And so the people who are renting, that another third of the economy, they're the ones who are really doing it tough and really finding it difficult in terms of, cost of living.
Yeah.
Where are you seeing that? You mentioned early signs, and granted we're coming off a low of 0 here, but just more specifically on repayment stress, for example.
Yeah, so there's no geographic indicators there. There's no particular states or parts of the country doing particularly badly. It's as we know, 90% of when people get themselves behind on a home loan in Australia, there are 3 causes for that, and they're generally shocks to their income. I lost my job, I got ill and I was unable to work, or I got a family separation. They continue to be the 3 big drivers of people getting themselves, mostly people starting to lose their jobs. And there's a new little category emerging, which is this cost of living issue. For some, they just can't make the books balance, but it's still very, very small, as I mentioned. So to give you a number, we've got about 1 million home loans on our books. The number of people who are in hardship, who are struggling, a couple of thousand. So it's a relatively small number in a percentage sense.
So you think, I think where your swaps consensus is thinking that this RBA may be able to start cutting rates maybe in the back half of this year. Does that look right to you, to follow the Fed in some ways?
Certainly said the house view at ANZ is that we'll probably see rate cuts towards the end of the calendar year. My personal view is that's still optimistic. I still think that inflation is more hard set in Australia and around the world than people think. Why? Because it's starting to become, it's being built into people's expectations. And what we're seeing is, wages are growing pretty well. And so people are out spending that little bit more money. So the economy is a bit more robust than I think we give it credit for. So I personally think it's going to be a lot harder to see inflation come down into the target ranges, certainly in Australia, but I think that's true in other parts of the world as well.
Is the next move a cut? Is the other question that, you didn't allude to it, but I'm wondering what you think.
Look, I think the next move is a cut, but you can't rule out a surprise here. Right? The reality is that what have we learned over the last couple of years is that we should expect to be surprised every now and again, and inflation has been more stubborn than people thought. And so I don't think it would take a lot for us to see a rate hike. So again, it's not my base case or certainly our house view, but you could certainly build a case pretty well, I think, to say that. And I think, the RBA have, in their language have sort of said it's still on the table. They haven't ruled it out. So we'll wait and see.
What do you look at in terms of resources demand now, too? I mean, that seems to be slowing, whether you look at China or other parts of the world. What does that mean for the Australian economy?
Look, the Australian economy is still remarkably in good shape, right? And let's not forget, again, it depends on your time perspective. I sort of stand back and think about it in a longer perspective, sort of 5 to 10 years. We've got an economy in Australia that actually wants to spend a lot more money in terms of its own infrastructure. There's still an infrastructure deficit in Australia. There's big spending plans, quite rightly, around things like defence. We've got a massive housing shortage, like many parts of the world, and we've got to get people out there building homes, apartments, etc., and all the infrastructure that goes with that. So and then, of course, the big one out there, energy transition. The energy transition, the demand on that side is huge. So you sit there and think, well, there's still a lot of money that needs to be spent in our part of the world, and not just in Australia. Just look around here in all of Asia, and that's going to keep demand going pretty well. Guess what drives a lot of that stuff, or where a lot of that stuff drives demand for things that Australia produces. So whether that's iron ore or whatever it might be. So I think the demand over time for resources is still intact, still a very strong story. Okay, they're going to be blips along the way. Iron ore's dipped below $100, still $100. It's a pretty good price when you look at the cost of production in Australia for those sorts of commodities.
That takes us into the broader trade activity conversation, and then, a lot of your business is tied to the global economic cycle. Let's shorten that time horizon. So over the longer term, things look okay. What does the next 12 months look like to you? Like, what assumptions is the bank making?
Yeah, so for us, just for people watching, our business internationally is intermediating trade and capital flow. So our customers move things and money around mostly Asia Pacific.
You're a trade bank.
Yeah, and we facilitate that, whether that's doing currency trades for them or the actual trade itself. So we get a lot of data in there. Look, it's still very stable. What we've seen, particularly with the dominance of China and a lot of those trade flows, that has diminished just a little bit, particularly if you're talking about Australia, New Zealand, part of the world. So we've got more and more diversified places that we're trading with, whether it's a Thailand or a Vietnam or increasingly in India. So our business is shifting, if that makes sense, sort of geographically quite fast, but overall, total volumes that we're seeing are more or less the same, pretty flat, but there's quite a big shift under the covers there between various countries. So that, we need to respond to that as a bank. So we're building out our capability in places like India or like Vietnam to help with that capacity as we see those trade flows and capital flows shift.
Which brings me to my next one, your commitment in the mainland in some ways. Obviously, ANZ has retreated from Mike Smith's old kind of super regional strategy, which meant heavy capital investment into China. What is the business strategy in the mainland for you guys now?
So I think on some measures we're still Australia's largest investor in mainland China. We've got about 300 people there. We're an on-the-ground business. We actually have people. We do things on the ground. We're not just selling things remotely. We will go where our customers need us. As I say, we intermediate trade and capital flow. We deal with the world's largest companies, whether they're from the United States, European, Australian or Chinese. And, where they need us, we go. So right now, there is still an enormous demand for our services on mainland China. Our business there is growing, not shrinking. Same here in Hong Kong, and we'll continue to invest in our platforms and capabilities in Hong Kong and, of course, in mainland China. The retreat from Asia sort of got overblown a little bit, the retreat from the super regional strategy. That was, by and large, retreating from a retail banking strategy, which, we just didn't have the scale to compete in that. So institutional banking, which is what we do particularly well, that is continuing to grow. And in fact, from our perspective and from our shareholders' perspective, even more importantly, the profitability of that business has significantly improved. 8 years ago when I started, our international franchise had an ROE of sort of 3%.
Yeah.
Today it's mid-teens and really, really sustainable. And
what more
continue
can
to
you
grow.
do outside of Australia in the institutional business to expand?
Well, we've got a strategy that follows our customers. We have 6,500 institutional customers globally. Big chunk of those are other financial institutions. Most of them are the world's best multinationals, and we go where they go. And so as they move, as I said, if they, we know the China Plus One strategy has been intact for quite a while, and as they're out there wanting to invest more in Vietnam and India, but also places like Japan, we follow. So we go there as well, and we build our capacity to follow them.
You mentioned 6,500 institutional investors.
Yeah.
That number has shrunk substantially.
Yeah.
From, I think, nearly 30,000.
Correct.
Does that number stay, or do you see that falling even further?
No, I don't think it'll fall further. I think it's pretty stable. There may be a little bit of growth in there. We certainly have no ambition to reduce it. I mean, our strategy, we're pretty comfortable. We've got the right 6,500. There'll always be people we need to add to the list.
Yeah.
But no, that is about the right scale for us. I mean, institutional banking is a risky business. You take a lot, we've got a lot of balance sheet out to those customers, and our philosophy is we'd rather sort of know these people really, really well. And 6,500 is about a number you can get your head around and know certainly the big end of that list, literally intimately, and know them really, really well.
What about your non-core international divestments, right? You did recently cut your stake in AmBank. You haven't quite found a buyer for Pen & Bank just yet. I mean, what's the outlook there?
So we only have three what we call partnership stakes. So they were minority investments. We've actually sold quite a few over the years, but yes, we've just sold 16.5% of AmBank. We've made it very clear they don't really have a place in our portfolio or our strategy going forward. So we are actively looking to find alternative buyers for those. So it's something that we spend a bit of time on. It was a good step forward for us to sell the AmBank stake. We're really pleased with that. We had a great relationship, but we need to move on. They need to move on, and they're better to have more stable shareholders.
Yeah.
Panin, same thing. We work really closely with our partner shareholders, but we'll look for a solution there. And then we have a small stake in China at Bank of Tianjin.
And on those two, Pen & Bank and Bank of Tianjin, do you have a timeline for that? Is there an ideal time where you think...
I wish I did, in the sense that I don't get to control the timeline on those things. I mean, look...
Well, what would you like to see, ideally, for you?
We would like... we are not helpful shareholders, if I'm being very honest, to either of those parties. Our strategy has changed. We don't have the resources to really lean in and contribute to either. So we're probably more of a problem for them than not. So the time, if I'm being totally honest, and so, look, I think the sooner we can just find more appropriate shareholders who can actually help, because both are good franchises and they need somebody who's going to lean in as a supportive partner. Not to say we're not supportive, but I just don't think we're the best shareholder for either party. So the sooner we can clean those things up, I think, the better.
Yeah, I mean, domestically, the court cleared this takeover of Suncorp for you guys, which is obviously good news for ANZ. Are you expecting more consolidation in the banking space?
I expect that, I mean, we still have over 100 banks in Australia. A lot of them are very, very small. The reality, and it's down over time. I mean, the reality is, globally, and particularly in Australia, banking is a scale game. And it's a scale game largely because of regulation, compliance, things like cybersecurity, and all of those. You need real scale to be able to service your customers well in a world of technology. And, that makes it more and more difficult for the small and the region, what we call the regional banks, and the mid-size, the people who've got, 2, 3, 4% market share, becomes more difficult. I mean, I'll give you an interesting stat. ANZ, we spend more on cybersecurity than Suncorp spends on all of its technology, right? So it just gives you a sense of the sort of scale you're talking about. You can't say to your customers, we're slightly less secure, but that's okay because we're small. There's a minimum bar. You have to be at the top of your game. And so I think scale is becoming more and more important. That's not to say there is not a very, very important role for regional banks who find a point of, a niche, a specialisation, something they can do very, very well. And, some of them are doing quite well. But I think there will be further consolidation.
You're sitting on some cash, right?
Yep.
You've raised some cash in divestments, and some of the capital requirements that have a representative office. You have that money too, and I'm wondering whether you're looking at using that for any acquisitions. You mentioned, we talked about consolidation. Are you actively looking to buy assets in Australia?
No, not really. I mean, Suncorp is a big one for us. This is $4.9 billion. I mean, this is from our perspective a really high-quality asset, and we really firmly believe we'll be able to drive better outcomes for their customers once they're part of the ANZ stable. We've got our hands full doing that. These things are complicated, as you can imagine. We've got to move 1.2 million customers from Suncorp Bank across into our systems. That'll keep us busy. Remember, we're also doing our own work. We've essentially launched a whole new bank in Australia called ANZ Plus, which is a digital through-and-through platform, really exciting. And we are migrating all our customers onto there. So we've got our hands full. We've already got 650,000 customers onto that platform, which is really exciting. So we got a lot on. No, we're not actively out looking for acquisitions in Australia. We always keep an eye open. You never know. You've got to stay close to the ground, particularly here in Asia, where things move really quickly. But there's nothing actively being pursued at this point.
I was going to ask you about overall succession plans. I mean, you are the longest-serving CEO, Australian banking CEO. You're 8 years at the helm. Is there a succession plan in place?
There's always been a succession plan. I mean, globally, I'm still a baby. 8 years, that's nothing. I'm only just getting started. Succession planning is something the board and I take very seriously. Obviously, as time goes by, you take it more seriously, as you can imagine. So, look, we're very lucky at ANZ. We've built a really fantastic cadre of leaders. Many of them have sat in the chair here, actually. You've met some of them.
Yes.
So we've got a good talent pipeline of business leaders, etc. So that's my job, is to make sure that when the time comes, the board has the best possible choice. And
Would you like to stay longer?
I love the job. I love doing what I'm doing. I feel very privileged to lead such a great organisation. And as I said, I'm still really energised about it. I say to a lot of our young people, actually, when you sign up for banking, you are signing up for change. I mean, the industry is changing really, really fast, and you have to be excited about that change and the opportunities that new technology brings. You know, the latest thing we're all talking about, obviously, generative AI, and that's going to fundamentally reshape the landscape of banking. I find that stuff interesting. I find it exciting, and as I said, it's a privilege to lead the group.
Shayne, it's great to have you here in the region as well. Shayne Elliott, ANZ CEO, is here in our Hong Kong studios. Of course, we're going to recap that data we got out of China, which was, for the most part, better than expected, right? If you take a look at how industrial production and fixed asset investment is concerned, I mean, that was a sizable beat there. The weakness a little bit still is disappointment, retail sales, property investment. That remains still the gloom in this economy. We're down some 9% there for those year-to-date figures. We did see that strength, though, a bit of a reversal when it comes to dollar renminbi and the like.
Yeah, a bit of a whipsaw when you look at equity markets, though, and as we'll continue to report and keep you guys up to date, of course, on this press briefing that's taking place there in Beijing. Away from that story, the other one is really Japan. So the Bank of Japan, of course, day one today, day two tomorrow, and will they finally raise interest rates for the first time since 2007? Stephen Ingles is with us in Tokyo. Steve, will they or won't they? And should they?
Yeah, that's the question, right? It looks like they will, because, again, all the major news outlets here in Japan, Nikkei, Jiji Press, Kyoto, all saying essentially that the Bank of Japan, after the two-day meeting today and tomorrow, will indeed exit 17 years of negative rates, essentially raising by at least 0.1% to that range of 0 to 0.1% range. But big question is, how much telegraphing will the fairly dovish Governor Ueda give at the press briefing at 3:30 local time tomorrow? We did talk to the former deputy BOJ governor earlier this morning, Wakatabe-san, and he essentially said he's not going to give any forward guidance. He is going to say the situation as it appears right now for his justification, perhaps if we're getting ahead of ourselves, for the hike in the interest rates, because again they want to be continue to have the accommodative messaging, and again the BOJ is haunted by the political blowback of dialing back, stimulus too early or too prematurely in the past. And they want to make sure that inflation is sticky. And all along they've said we want sticky inflation well above the 2% target, of course, which they are. But there's disinflation right now. CPI is down to about 2.2% again. But they need that backed by wage gains. And they got the wage gains. OK, so the wage gains were good, according to the latest junto, at least initial, concessions, essentially at 5.28% was the first round from the Rengo on Friday. So this is good indication and probably a very big reason why the BOJ will likely hike rates tomorrow.
Yeah, and it seems like the economists are all catching up now. You're seeing more and more like the likes of Goldman saying, look, maybe it is March versus April. Is this more likely to be the consensus now that, it's more going to be tomorrow, really, Steve?
Well, that consensus has changed pretty quickly. In fact, you mentioned the Goldman note that came out this morning, and they essentially cited things have changed in the last 72 hours because the main news papers here in Japan, especially the Nikkei, the Nihon Keizai Shimbun, which essentially, if they're printing it, oftentimes, it's been essentially leaked to them, and you kind of almost view it as fact. So they cited in their report today, Goldman Sachs did, essentially because, again, those wage gains that I mentioned, but also the consensus seems to be in the last 72 hours changing because of those reports, that they do, in fact, now believe that tomorrow, in fact, there will be a hike. Basically, this is what they're citing as well, that the BOJ has not sent any signal denying the news. Now, they're in a bit of a blackout period right now, but again, there's been no effort to quash these rumors that the hike will happen tomorrow. It basically indicates the BOJ has enough has enough data right now and no longer needs to wait for the quarterly economic report that is coming out next month. So I'll be here tomorrow.
Oh, man. Get ready, Steve.
Yeah, get some sleep.
Get some, yeah.
Yep.
I don't know how cold. Is it colder than there in Tokyo versus Beijing last week, Steve? I don't know. You got to bundle up. I feel still.
I still have the cold from Beijing for sure. So I'm hoping.
We hear it.
Okay. Bundle up, get ready. We'll be ready with you, Steve. Yeah. Our Chief North Asia correspondent, Steve Ingles, joining us out of Tokyo ahead of that crucial BOJ meeting on Tuesday. All right, HSI looking like this. We talked about this bit of whipsaw when it comes to what traders are looking at when it comes to this data dump out of China. We're flat basically on the Hang Seng now. CSI 300 still punching slightly higher. The Nikkei, though, that's the one back in vogue or back in style. We're up some 2%. Plenty more ahead. This is Bloomberg. All right, Taylor, when it comes to markets here this morning, we're watching very closely when it comes to brokerages. Certainly there's been some chatter there about talking about investment and, a nation's vow for top investment banks. So you've seen the likes of CICC up some 5% here this morning. CATL remains that outperformer when it comes to what we're seeing in the onshore market. Obviously, that earnings beat. You have analysts continuing to raise their price targets for that stock here. Just given the fact that they were able to defy a lot of the competition that we're seeing in the EV space here right now to still come out quite on top here. So EV is very much in focus. Xiaopeng, XPeng, coming out with earnings this week as well.
Yeah, in fact, we're going to have a fantastic roundtable coming up here on all things EVs and really talk about these earnings coming through. And, it's really not just CATL, for example. I think a few weeks back, Li Auto, of course, came out with, a surprise set of numbers outside of what the narrative was at that point in time, and really have things changed. Anyway, lots of that coming up later on in the show. BYD, as you can see, 3% higher about an hour into the session. And as we were just pointing out, there's China's EV makers gear up to report their latest earnings. We look at why a vicious price war might not be sustainable. And we're perhaps stating the obvious here in the longer run. HSBC joins us to talk about the industry and the prospects next. This is Bloomberg.
Central banks in Asia have generally been holding tight early this year. I think they're waiting to see the Fed move first before easing further.
And what they're going to do is to raise the policy rate, and they are going to end the negative interest rate policy. And I think that they are probably going to raise that to 0 to 0.1%. Also, they are going to end the sort of new purchase of the ETF and the JRE.
But the Bank of Japan, clearly is on the path to normalizing, and whether it's this meeting or next, it's almost going to happen. Having said that, if they move, we'd expect them to move, but also at the same time talk expectations down, so they don't want to have a runaway policy expectations of higher and higher rates. They'd want to push back against that.
Yep, some of our guests today on Bloomberg TV on how the Bank of Japan could move when it comes to Tuesday. And take a look at when it comes to this equity market there in Tokyo. It is back on fire, up some 2% this morning. The Topix is up 1.5%. Dollar yen has been weakening in terms of the yen for, I think, 6 straight sessions now, Dave. So the market seems to be coming to terms about what really could happen tomorrow. And they're not really that worried in some ways.
First hike in 2007. I think the question now is it one and done? And, we keep referring back to this Goldman Sachs note, which came out a few hours back, and it doesn't seem tomorrow is going to be the only rate hike that will deliver.
Yeah.
In fact, Goldman thinks, I'm paraphrasing, so if anyone from Goldman is listening, I apologize for this. I'm trying to hit the spirit of the note here, that we will get more increases or tightening as this process of normalization comes to fruition. Our question of the day, by the way, for our Bloomberg clients on the BOJ is how long before the 10-year JGB, currently at 77 right now, reaches 2%. There we go. Okay, top of this hour, data coming out of China, and takes us live to the press briefing in Beijing. A beat on most, not all, metrics for activity numbers coming through. More lines out of the National Bureau of Statistics here, and this pertains to real estate and the property market. And so far the commentary there is it is still in the process of adjustment. That's how it's being phrased at the moment. There we go.
For more, let's bring in David Chu from Bloomberg Economics. He's with us right now. How should we read this recent data, David?
If we have only one word, we would say better. Well, better than expectation and better than last year's actual data. So especially in the supply side or in the production side, if you look at the industrial production and also the fixed asset investment, both are better than expected.
What about the real estate market? They talked about how it's still in the process of adjustment.
Yeah, based on the high-frequency data we saw in the first 2 months, the housing sector is still weak. You know, I think this is going to translate more weakness into the investment side. I mean, the housing investment. But on the other hand, we have seen that it should be the infrastructure investment led by the government that somehow offset the weakness in the housing sector. So that is why we saw the FAI, the fixed asset investment, 4.2%.
Yes.
Industrial output, though, that seems to be the more sizable beat, right? 7%. What do you think was driving that?
Well, I think you mean the infrastructure?
Industrial output. Output.
I think it's some of the reasons are, if you look at the by-sector data, you would see that it was mainly the industrial materials sectors that was supporting the industrial production. And this is in line with the macro data that the consumption side is still weak. But on the other hand, we saw the infrastructure and also the car manufacturers was still good. And also, somehow, I think that is because of the bad weather in mid of February that drove the production of heat and energy. So that was also a support to the overall industrial production.
A further line coming through out of the spokesperson of the NBS here, that China has the ability to achieve the growth target for the year. ANZ just put out a note following these numbers. I want to get your reaction, David, to this, is that the numbers to them look solid, and that might delay any rate cuts that might be on the cards. What do you think this means for monetary policy? And do you agree with the view from ANZ that the data is solid?
Well, first of all, I agree that the data are solid. But on the other hand, if the PBOC doesn't do more cut or easing, that would be a risk that they could repeat what happened last year. In last year, in the beginning, we saw the data also solid, and also, remember, China just reopened from the pandemic, so that everything looked good. So the PBOC slowed the pace in the in the second quarter and the third quarter, but we saw what happened in the following, right?
Yeah.
So that I think the PBOC still needs to cut to avoid repeating what they did last year.
David, thank you. David Chu there from Bloomberg Economics. Of course, you can go to TLive Go to check out more analysis coming through here and what we're hearing from this National Bureau of Statistics presser that's happening here right now. Of course, the latest line saying that they think the conditions and support for China to achieve this year's 5% growth target. We've got plenty more ahead. This is Bloomberg.
Welcome back. You're watching the China Show. Well, officials are saying that they will take pragmatic measures to support the growth of the new energy vehicle industry. And the call comes as domestic EV makers gear up to report their latest quarterly earnings. And that's the agenda, as you can see, and the names coming through. Xpeng leads the way out on Tuesday. BYD, of course, reporting, as you can see, further out next week. Now, the results could actually provide better insight into the impact of this current price war started by Tesla and how the strategy will impact some companies and what they do. Our transport reporter, Linda Liu, reports.
This is the BYD Atto 3, an EV that's popping up on the streets of Sydney, Berlin and Sao Paulo. And more Chinese EVs like it are being exported to the rest of the world. In fact, Chinese car makers now account for half of all global EV sales. They benefit from access to minerals and the cost-effective supply chain built over years. And from 2016 to 2019, Chinese car makers received $28 billion in government subsidies. That rebate program was phased out in 2022. So now China is entering a new stage of EV adoption.
The transition from a traditional ICE to new energy era is still unstoppable. So I think we're still very hopeful, it will bring a lot of growth opportunities for us.
Car makers want to make inroads in smaller towns and rural areas, but to do that, pricing is key. The competitive auto market is in the midst of a price war, started by Tesla 2 years ago, showing no sign of slowing down. BYD, Xpeng, Geely and Leapmotor have all slashed prices to follow suit, raising questions over the sustainability of the strategy.
When you look at the intense price competition that you're seeing in China right now, that's not sustainable for any company.
The price war that's happening, it's a Game of Thrones price war that's happening in Beijing.
The record deliveries don't always translate into bumper profits. When BYD overtook Tesla as the world's top EV seller last quarter, preliminary profits for the year were short of estimates by $500 million, and shares slumped. With the lack of government funding and a slowing domestic market, EV makers that do survive will have to come up with even better, cheaper products and sell to overseas buyers that may not be friendly to cars made in China. Linda Liu, Bloomberg News.
All right, let's bring in Linda now. Just did that piece, and also joining us is our guest from Beijing, Yuchen Ding, head of China Autos Research at HSBC Shanghai Securities. Linda, I'll start with you. How might this price war really impact earnings for some of these automakers now?
It's a really rough time for everybody in the EV market right now. BYD is leading the charge with slashing prices on a lot of their popular models. This is continuing a price war that was started by Tesla a couple of years ago. So it's really hitting the margins and profitability of these automakers now. BYD is the top seller, so they have some leeway to wage this war, but you can't say the same for some of these smaller players like Xpeng, Li Auto, or NIO, whose sales are suffering, as well as taking a hit from this price war.
So we laid out the companies coming out with earnings this week. So apart from the actual numbers, is there any specific guidance or tone that you're looking to hear on the price war from executives as they talk to investors?
Yeah, the executives actually met in Beijing over the weekend for this top level EV events, and they're actually laying down some pretty ambitious goals. You've got the car business unit leader from Huawei who's saying they want to be the top player in offering advanced assisted driver systems, so having a lot of high-tech features in cars that are working with Huawei. And you've also got others like NIO's William Li saying that, we're trying to improve our battery technologies to make sure that customers are really getting good value from their cars, which is more expensive than some of their rivals. So you've got these top-level executives trying to think of new ways to attract customers in the coming year.
Yuchen, I'll bring you in right now on what you're seeing when it comes to these price wars. Are you thinking price cuts are likely to continue in this space?
Yeah, I would say China EV is mainstreaming. We're basically in the process of consolidation. So during the process of consolidation, I would say the pricing pressure would be part of life now, because the laggers probably struggling at a subscale might have to cut the price for more volume just to stay relevant. And the same price action has been noticeable from the leaders such as BYD and Tesla. So this is part of life. But the key debate or the key watch here is when you cut the price, can you boost the volume to partly mitigate the pricing pressure, what we discussed earlier?
Yuchen, David here. So you talked about volume then. What are your assumptions on how much they sell? And just put that also into context of the penetration rate, which I believe based on your report here is at 43%.
Yeah, so our full-year forecast for the EV penetration this year is around 45%. And also over the weekend, the chairman from BYD talks about in the EV event this last weekend that in the coming 3 months, the high-frequency EV data probably over 50% EV penetration in China. So we do notice strong EV demand picking up starting from March, post the weak seasonality in January and February, and partly we've seen the wait-and-see consumers who are waiting for better price probably ready to commit their orders.
And what does this mean for? I mean, the market seems to be quite concerned about the overcapacity in the EV space here right now, and also when it comes to if you continue to cut prices, that's going to lead to more, geopolitical tensions with the U.S., with the European, markets as well. I'm just wondering how should investors look at some of these concerns?
Yeah. Two parts of the question. First of all, overcapacity. I think government stopped issuing new EV production certificate since 2017. The problem is the existing status quo is still simply too much. We have too many brands, too many models on the market, so the industry is due for the consolidation. We do notice there's some smaller player reported to halt production and halt paying the employees, and also many of other brands talked about cutting the existing capacity in China. So we've already seen the industry consolidation on the move, and the market is basically the key. The market mechanism is the key drivers in the process. On the other side, to navigate increasingly more complicated global trade environment, we do see the potential in-market supply could be a rather effective way to mitigate these trade tension, as well as the tariff and FX risks. For example, BYD has been reported to open the new plant in Europe, in ASEAN, and also South America.
Yuqing, this is Linda here. I'm really curious about what you think of Geely. It's an interesting company who just said that they aspire to be the Volkswagen in the new energy vehicle age. How do you think Geely is going to balance all of their brands to really try to come out ahead?
Yeah, great question, but we're currently restricted on Geely. But to the topic about incumbency company moving towards the electrification, we do notice there's a couple of incumbency names has been doing quite a good job by establishing a dedicated EV brand and also actively employ direct sell and also advanced driving assistant functions into their new vehicle. So both the EV pure play as well as the incumbency moving towards the EV going to remain to be the mainstream player for the EV playground.
Yuqing, as a follow-up, I guess, to you mentioned incumbent, which among the stocks that you cover, among the companies that you cover, which one has the least visibility in terms of just looking, either that's a year ahead or 5 years ahead?
A great question. I would say the SOE incumbencies as a group in general is facing a more challenging environment in terms of the competition. The ICE business has been contracting in terms of the profitability due to lack of scale and also severe pricing war. I would say generally Dongfeng and Bike under our coverage probably has a bit of a rough patch to go through, while their EV business is still on the expansion phase, and while the incumbency profit pool has been shrinking. And this has been reflected in the reported 2023 earnings.
And what does it mean for, the number one, BYD then? I mean, obviously they maintain that lead amidst this fierce competition. What is the next road for them?
Yeah, great question. So first of all, I would say they have aggressive price action by introducing the budget version. So although this could this should partly pressure on the profitability, but on the other hand, lower entry pricing point also attract more demand. So the order book momentum and the increasing scale will help them partly mitigate the pricing pressure. And the continuous scaling in China would be the key focus, and another leg of growth probably coming from the overseas market. We talked about BYD's has been expanding overseas, and they have been expanding their production over there. And also, given a rather more favorable competition environment in overseas market, their overseas business has been yielding much better margin than the domestic market. So domestic market, we're also expecting in the second quarter the platform refresh, which is supposed to drive from the second half of the year another round of the product cycle refreshment.
Linda, question to you here. You have new entries. You have Xiaomi. You have Huawei entering the EV competition. And Chen, listen to the question because this also goes to you in a moment here. But I want to get your thoughts, Linda, on what this means for the current players, of course, in the industry.
So these tech giants entering the space is really going to put the focus on high-tech features in EVs. Huawei said that they want to be the top in advanced assisted driver system, and Xiaomi is really pushing this car ecosystem they're coming up with. They want to provide a seamless experience for drivers. You know, you can be listening to an audiobook on your phone, and when you enter into your car, it will pick right up, playing it on the stereo. So with these focus on technology, it's putting the pressure on market leaders like BYD, who actually hasn't had such a big focus on these in-car technologies previously. So now BYD said that they're going to catch up and investing a lot more into the sector. And again, it comes back to profitability, because these developing these kinds of functions and features aren't cheap. So in the long term, if you want to stay on top, you've got to spend this money.
Yeah. I mean, we saw what happened with Apple, right? Chen, your thoughts on new entries and how the incumbents respond to these new entrants?
Yeah, I think the broader industry context would be EV is increasingly commoditized. So smart EV is the next game changer. The technology entrance Linda just talked about does have a strong differentiation on that front. But I would say the other EV names is also playing strong, catching up. BYD has been employing more R&D personnel last year, and that in earlier this year, their tech day, they do talk about moving towards in-house software generation. So that's supposed to be reflected in the next generation product, and they might start it from the high-end models first. So I think everyone is moving because they all understand that smart EV is the next game changer, and the OEMs who have the scale, who have the in-house software capability, would be the potential winner.
Fantastic. Thank you so much, Chen Ding, Head of China Audits Research at HSBC Shanghai Securities, and also here on set with us, our Asia Transport reporter, Linda Liu. Now, we'll take it straight back to Beijing, National Year Statistics, press briefing, and we're not talking about the jobless and the labor market situation here. A couple of lines coming out. The situation is stable in the first 2 months, and in 2 or 3 days, or within 2 or 3 days, China will be releasing the youth jobless rate coming out. So stay tuned literally for that. All right, plenty more ahead. This is Bloomberg. Right, you're back. Time for your China brief. I look at the stories making headlines in the newspapers and also online. The Shanghai Securities News says overseas capital is flowing back into the Chinese market. It's reporting that foreign funds are growing more upbeat on A shares due to attractive valuations and also Fed rate cut expectations. And of course, we're getting an update on those rate cut expectations literally this week on the dots. While staying in China here, another article suggests that recent capital market reforms are expected to boost investor confidence. It says new guidelines are a response to market concerns and perhaps a better balance both function and profitability, Yvonne, for those banks and those funds.
Yeah, a lot of focus on what stocks are doing here these days. Meanwhile, when it comes to what we're hearing from Chinese state media, calling out BMW. at its annual show. Of course, this is the one that airs out some of these consumer complaints about tech issues and poor service. That's what we're hearing when it comes to BMW this time and why they decided to highlight that. So the program criticized the German automaker for technical defects on its 5330 Li model, which was designed specifically for the Chinese market. According to this report, consumers filed complaints about abnormal sounds. They were saying BMW and local dealers did not provide satisfying solutions. And the car maker has since taken to Weibo to apologize. They say the issues will not affect the safety of the vehicle and that the firm will bear all related maintenance costs. Now, the quick response seems to have pleased some netizens out there. Some users also pointed out that it's normal for moving things to make a little bit of noise, right?
Yeah. There we go.
It's a car.
Well, yeah, if things are completely silent, that's when you worry, right? Okay, so that's the China brief for today. A look at what's happening across these markets right now, and broadly speaking, right? So we're actually on better footing than 90 minutes back in terms of risk assets, although that being said, a pain point continues to be resources, mining, and with iron ore down about 6 days right now. 6 straight days as we speak, rather. U.S. assets, futures, in fact, are pointing now slightly higher. In fact, we are near, if not at session highs in U.S. futures. There we go, 0.2%. That's it from us here at the China Show. Plenty more ahead. This is Bloomberg.